Holding strong. We are holding very, very strong. The fact that we've added only to yesterday's comeback, I think, is quite special. Indian markets are still down 6% for the year. So we may talk about outperformance, but the real returns are actually down in last 1 year. And that, in a sense, is also getting captured in the way how valuations are moving. So same time last year, Indian markets were trading at a higher P multiple. And a year from, and if I look at the 1 year forward P multiple for next year, the P multiple for Indian market now is no longer at a very stretched level. It is at a marginal premium to what the historical averages are. That graphic point will just come up on your screen. Nitin Raheja, Executive Director and Head of Discretionary Equities with Julius Baer joins us now. Nitin, great to have you back. Thank you for joining us.
Thank you.
We've done very well for ourselves if I look at the world. But if I look at purely Indian markets in an absolute basis, we've given no returns in last 1 year. What is the right way of looking at the market? The world has fallen and we will fall, or we've given no returns in last 1 year. So next 1 year, we will definitely get positive returns on the index.
Well, Nikunj, it's not unusual for Indian markets. Also, we have seen that in the past where you have a year of consolidation after you've had 2 great years that we saw till, say, November of last year. So in that sense, if you really see that, we are in a consolidation mode, in relative to global equities, when global equities have come off and we have one of the better performing or among the best performing markets, I don't think we have a lot that we should be disappointed over. And I think that if it sort of helps us to sort of our fundamentals to try and catch up with where valuations stack up, I think it's a good thing because, I like you just alluded to, I said, when we take a forward view on this in terms of where the earnings are expected to be consensus for the markets next year, and you apply the long-term multiples, I think, this is a buy on dips market. This is a market where there is an upside if earnings pan out the way it's expected for FY24.
Why a buy on dip? The problem with that thesis, Nitin, is that the dips are not large. They are not sufficient enough. Markets are not coming in what the value zone is. For the better part of last couple of months, we've traded above the fair value. So if you're waiting for perhaps Robin, if you're waiting for, Robin, then summer's going to get over.
Well, the point is, Nikunj, like you said, if you don't get those dips, the fact that there's time correction taking place in the market is making the fact that, your earnings are catching up, which again sets the ground for the, so even if you, look at it, if you look at where we have been over the last 6 months, we've practically been in this range and we've been going up, down, essentially we've been where we are. In the meantime, earnings growth has been catching up. And when that happens, you're actually setting the stage for the following year and so on and so forth. So I just think that even if you don't get dips, if you're really taking a forward view on this, clearly there is upside in this market. In fact, very interestingly, we have done an internal sort of analysis and study. If you look at the last 20 years, our 20-year nominal GDP growth has been close to around 12.1%. That's pretty much in line with where our markets have delivered. If you take a lot of large cap and the index returns on a rolling 10-year basis across time periods, you'll see that's pretty much 12.4% is where your market returns have averaged. And then if you take the historic P over a 20-year period, and I'm talking of historic, not forward numbers, you will find that our markets have traded at about 21 times historic. That's almost a value multiplier to nominal GDP of almost 1.7 times. If you do your maths going ahead for the FY24 numbers, based on Bloomberg consensus estimates and apply that number, you clearly see that there is a good 15% plus upside to these markets based on FY24 numbers. And that's why I said, if the markets were to correct, they in fact present an even more, better and more attractive opportunity.
Right. Well, tomorrow, of course, we'll have IndusInd Bank as well reporting its numbers. Just given the kind of positioning that you have on the stock, it's going to be quite critical, this number. In fact, Harsh is waiting by to tell us what the street is anticipating from their performance this quarter. Harsh?
Well, yes, now IndusInd Bank will be in the spotlight. We're expecting the net interest income to come in at around 4,300 crore, thereabouts. Around 17.5% is the number we're looking at in terms of growth year on year, 4+%. sequentially. We are also looking at operating profit coming above that 3,500 crore mark. That's a solid 3.5% growth sequentially, a nearly 10.5% growth on a year-on-year basis. Provisions to continue to trend lower. We're seeing provisions at 1,250 crore in Q1 of FY23. We're expecting it to see it around the 1,100 crore mark in Q2. That's down around 12% sequentially. And PAT therefore will go up. 1,730 crore is where that PAT number is expected to come at. 6% growth sequentially, 51% on a year-on-year basis. So keep your eye out on that. In terms of numbers already disclosed, advances have gone up 4+%. So have deposits on a sequential basis. So growth on both sides. Of course, more to see as to where that growth has largely come from, where the vehicle finance is the place where it's going to be at. But the key monitorable for the company will be largely on asset quality as well as recoveries and how the credit costs are trending. And so keep your eyes out on this one. Of course, the stock is up 30+% on a year-to-date basis.
30% plus appreciation year to date. Kunal, further scope, further headroom, you think?
I believe so. I think the stock has just given a breakout on the monthly charts, and I think post the results, assuming if there is no major damage to the stock price, and the stock holds on to this 1180, 1200 support, then I think it's going to be a good upside seen possibly for IndusInd Bank. The only thing is that the last 4 or 5 days when the stock has slightly underperformed the bank Nifty, there's not been any major change in the open interest. So neither there is any skew towards the short built up, neither there is a skew towards the long built up for the stock price. So that's just generally an indication that probably market participants are waiting out for the results to go by, and assuming if there is no damage to the stock price, you could probably expect the stock to get into the outperformance league.
All right, back to IT. Nitin Raheja, at the beginning of the year, everybody was excited, some were euphoric about the prospects of Indian IT industry. Now nobody likes that space. So was the euphoria wrong, or the current mood or the current somber mood dismissive?
I think neither, if you really ask me. Indian IT has gone through such cycles in the past, in fact, worse cycles. If you take 2000, it was a cycle which came about absolutely unexpectedly, suddenly, and you had this whole recession and the whole IT boom sort of, the growth sort of. After that, our IT companies have matured. They've actually grown through these cycles and know how to manage through these cycles. In fact, the big differential this time around, unlike 2000 or 2008, has been the talk of a recession in the US has been going on. So a lot of the IT companies are extremely, probably cognizant of that and are preparing much in ahead in terms of, so it's not going to be a surprise coming to them, and they've managed this in the past. The fundamentals of the business wherein they generate such strong profitability, large cash flows, pay out huge distributions in forms of dividends and buybacks continues where it is. So I just think that, what you probably will see around this time is the larger IT stocks have already shown their correction. I think they trade at very attractive valuations. The mid-cap IT stocks have corrected. I think there is yet some room there in terms of the valuations that they trade at. But I think IT as a pack is around and is probably going to, have maybe a tough 3-6 months from a market perception. And however, if the recession turns out to be muted, I think they will be back. And don't forget the trends driving IT this time around, whether it is digitization, whether it is cloud migration. These are fundamental strategic trends. They are not discretionary spends by companies. So all that you will see coming off from a spend perspective is probably the companies who have been, funded by venture capitalists. And so there was a lot of froth out there. I think that is something that you will start seeing come off. But I think businesses today use IT as strategic tool more than anything else. So I'm not, I think whether you were bullish on IT at the beginning of the year and you're not so bullish on IT is more a function of your perception of how you see the recession taking place. The IT business is doing well and they're delivering numbers. Infosys just also talked about this buyback that they're doing and so on and so forth. So I don't think anything is wrong with the sector per se. It's really the perception and the valuations. And I think there has been a correction out there.
Spend some time on the pharma sector as well, because while the entire sector may not be moving today, there sure are individual stars. Look at what a Syngene is up to. It's showing a massive 3% move. Granules is holding up 2% right now. Biocon, Glenmark, you're seeing gains in Sun Pharma. Cipla is holding up 1.5%. Cipla, in any case, has been in a blue sky territory. It's quoting at its all-time highs. Abbott is looking strong, and even the derivative space, Apollo Hospitals, Metropolis, these are all stocks which are looking extremely strong as well. Of course, earlier this morning, there was a note coming in from Morgan Stanley on Gland Pharma 2, wherein they've initiated coverage in Gland with an overweight stance, and the target price has been set at 27.48 rupees per share. They're saying that their entrenched presence in a difficult injection category, which makes them strong, a strong balance sheet. It's sharp 45% year-to-date stock price correction, and that shares are trading at very lucrative valuations, both on an FY23 as well as FY24 basis. And they're saying that the IP visibility for its complex pipeline is only improving. Nitin, are you seeing merit and value in at least having a little bit of an exposure to pharma, which has practically done nothing all of this year?
Absolutely, and I think we've also taken steps, and we have added pharma to our portfolio, because we clearly see the entire pharma stroke healthcare space. There are pockets of value that have emerged. The worst in terms of pricing has we believe been seen in the generic space, and some of these businesses are very high quality businesses who have where the US markets have really corrected dramatically in terms of their profitability profile and so on and so forth. So my own view is that yes, pharma is looking interesting. Right now, it's domestic pharma which is doing very well, and companies with a higher domestic play have benefited and have sort of held up well. But I think US pharma is also some part of the generics business is also starting to sort of bottom out and so on and so forth. So yes, there are pockets of value.
Okay, that's the take coming in on pharma. Nitin Raheja, great to have you on the show. We'll let you go on that note, but let's get in some BTST trades going. Rudra